Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Believe it or not, we are now 6 months out from the March 23rd lows in the market, and now investors turn their attention to what could be another unprecedented event in 2020, the U.S. national election. Joining me to discuss is Ryan Detrick, chief market strategist at LPL Financial. Ryan, it was great to see you. Welcome back to Trade Talks.
Thank you for having me. We were just saying there's plenty to talk about, so I look forward to it.
Yeah, definitely. And although nobody knew it at the time, March 23rd marked the low for the S&P 500 as it began a V-shaped recovery. Were you surprised by the speed of the recovery? And do you believe that the recovery only took place in a concentrated area of the market?
Well, I guess we'd have to say we were surprised, right? It took 5 months to make up the 34% losses, the fastest bear market in history, fastest 30% correction in history. So I guess it makes sense. Maybe you'd think it could be one of the fastest recoveries. But even then, I think most of us are surprised if 6 months ago we didn't expect this. But then you just kind of say, okay, we're up a lot, up over 40, well, up over 60% recently at the peak. And now we're looking at about a double-digit pullback. And now I know we're bouncing the last couple days. But it makes sense after a 60% rally to have some type of pullback. And you look at who's pulled back the most, obviously it's been technology and some of their true leaders. But so what's important to us, like today, is when we're doing this. Small caps are up 3%. Okay, we're seeing some participation in some of those cyclical value areas, materials, industrial, small caps. Yes, the large cap names have pulled back overall the last couple of weeks, but it's not like the market's just selling everything. You're kind of passing that baton around, and honestly, that's a real positive sign in our view.
Well, Ryan, do you think the recent pullback in stock prices is due to investors reassessing the durability of the recovery?
Yeah, it very well could be. And then you look at what's going on in Europe, right? They're starting to see a lot more cases starting to come. And, we had 1,000 cases in New York just the other day. So you're starting to wonder, could we have more rolling? We're not going to go back to a total shutdown, but more rolling shutdowns potentially. That's got people on edge. The fact that, for almost I guess a month and a half now, we've been talking about the next coronavirus potential fiscal plan. It's getting closer, it feels like, but that's not there. So there's all these worries that are there. At the same time, after a 60% rally, maybe it's just normal. You get to that troublesome September, October. Don't forget, October's the worst month of the year on average during an election year. So we all know September's a bad month, and it's been a rough month so far. So we're not quite out of the woodwork yet from a purely seasonality point of view, especially with the election and all the uncertainty that it might bring over the next 36 days.
Right. And of course, here we are. It's September 28th. We are, 36 days out from the election, and it almost seems that that's going to overshadow everything else. And COVID-19 is almost an afterthought. And it's not even just those 36 days. What's going to happen should the transfer of power or the resumption of power not go quite as smoothly as we've experienced in the past?
Yeah, well, markets hate uncertainty, right? So should that be the case, we saw back in 2000, right after that election had some issues. For the 5 or 6 weeks after that, until December 9th, the S&P pulled back about 5% or so. In the 60s, we saw something similar where there were some issues. So it makes sense if you don't have a smooth transition of power, I guess we'll call it. Market might won't like that, right? But again, I guess the positives are this global economy is really on firm footing. I mean, China is leading us out of this. They let us into it. They're leading us out. U.S. economic data is not perfect. I know the jobs numbers aren't spectacular, and at least the initial claims are being stubborn around 900,000 a week. But the manufacturing numbers we keep seeing, I mean, the Dallas Fed manufacturing number today, 2-year high, right? We're seeing some real positives on the U.S. front as this economy slowly opens up. But it's still, this recovery, it's going to be tough because there's certain parts of the economy that just simply cannot open up and will not be allowed to open up until we get a vaccine and get past the other side. And that's still a ways away.
Right, of course. And fundamentally, we understand what the outliers are. But are you seeing anything in terms of the way the market is pricing it in, let's say perhaps in the futures market, that we could be in for a rough ride even after November 3rd?
Well, we don't think we're in for a rough ride. I mean, again, if you think about it, small caps haven't made a new high for about 2 years now, right? We know certain areas of the market have really, really done well, but other areas are starting to come back in. So what does the book say? The book says November, December after an election, you tend to get that upward bias rally. Now, 2020 has been anything but the book, so to speak. But still, the truth of the matter is whoever wins this election, the economy is actually in pretty good shape, all things considered, and it's expanding. We're supposed to see 25% earnings growth next year on the S&P 500. That's a pretty nice tailwind as the economy keeps opening up. Whoever the president is, they're going to have a good economy, and that, at the end of the day, tends to be a better sign for how stocks are going to do than really who's in power in the White House or Congress, to be honest.
All right, Ryan, and to wrap up here, for a longer term investor, the volatility that we're seeing now, and most likely through the end of the year, could really lend to some nice opportunities. So where would you be looking to put money to work with the longer term investment horizon?
Yeah, we're sticking with who brought us here, right? That's the growth names. Look at the earnings that we're seeing out of technology names. I mean, tech's making more money now than it did 6 months ago, right? I mean, I know COVID-19 and the recession, but the tech, that's a really area we like. We like growth still. We like the healthcare names. So the other side of things on cyclical value, if the economy comes back a little more, those materials and industrials are two groups that we like. So tech over here, growth over here, and then your cyclical value over there are the two groups we think for a barbell approach that can do pretty well the next, say 6 to 12 months.
All right, Ryan, great to see you as always. Thanks for joining us on Trade Talks.
Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.